Insider trading. It's a term that evokes images of shadowy figures making millions off secret information. But what exactly is it? In simple terms, insider trading is the illegal practice of trading stocks or other securities based on material, non-public information. This information is typically gained through one's position within a company or through personal connections. Imagine, for instance, a high-ranking executive overhearing a confidential conversation about a surprise merger. This executive then uses this information to buy stock in their company before the news goes public, knowing the stock price will likely skyrocket. This is a classic example of insider trading. The key here is that the information is material, meaning it could influence an investor's decision to buy or sell a security, and non-public, meaning it's not available to the general investing public. Insider trading undermines the fairness and integrity of the stock market. It creates an uneven playing field where insiders with privileged access to information can exploit those without it. The stock market, at its core, is meant to be a level playing field. Investors make decisions based on publicly available information, such as company earnings reports, news articles, and industry trends. When individuals engage in insider trading, they disrupt this balance. They gain an unfair advantage over other investors who don't have access to the same privileged information. This undermines the very foundation of a fair and transparent market. Imagine a foot race where some runners are secretly given a head start. Would that be a fair race? Of course not. Similarly, insider trading creates an unfair advantage that distorts the market and erodes investor confidence. It's like playing poker with someone who can see everyone else's cards. It's simply not a fair game. This is why insider trading is illegal and heavily prosecuted. It's about protecting the integrity of the market and ensuring that everyone has an equal opportunity to succeed. To combat insider trading, a complex web of laws and regulations has been established. The Securities and Exchange Commission, the primary regulatory body overseeing the US stock market, plays a crucial role in enforcing these laws. The SEC's mission is to protect investors, maintain fair and efficient markets, and facilitate capital formation. Insider trading directly undermines this mission by creating an uneven playing field and eroding investor confidence. The SEC has a dedicated division, the Division of Enforcement, responsible for investigating and prosecuting insider trading cases. They use a variety of tools and techniques, including market surveillance, tips from whistleblowers, and sophisticated data analysis to detect suspicious trading activity. The legal framework surrounding insider trading is complex and constantly evolving. However, the underlying principle is clear. Individuals with access to material, non-public information have a duty to safeguard that information and not use it for personal gain. Over the years, there have been numerous high-profile insider trading cases that have captivated the public's attention. These cases serve as stark reminders of the consequences of violating securities laws. One such case involved Ivan Boesky, an arbitrageur who made millions in the 1980s by trading on inside information. Boesky's downfall began when he was investigated by the SEC for suspicious trading patterns. The investigation revealed that Boesky had been obtaining confidential information about upcoming mergers and acquisitions from Dennis Levine, an investment banker at Drexel Burnham Lambert. Levine, in turn, had been receiving this information from other insiders in exchange for kickbacks. Boesky's cooperation with the SEC led to the downfall of several prominent figures on Wall Street, including Michael Gutfreund, the head of Salomon Brothers, and junk bond king Michael Milken. The Boesky case sent shockwaves through Wall Street and led to significant reforms in the financial industry. The Martha Stewart scandal, a cautionary tale. Martha Stewart, the domestic lifestyle guru, became entangled in insider trading. In 2001, Stewart received a tip from her stockbroker, Peter Bakanovich, about IM-clone systems. The FDA's rejection of IM-clone's key cancer drug would send its stock plummeting. Acting on this tip, Stewart sold her shares, avoiding a significant loss. Stewart claimed her trade was pre-planned, but the SEC disagreed. She was found guilty of obstruction of justice and lying to investigators. Stewart served 5 months in prison and paid hefty fines. Her case is a reminder that insider trading laws apply to everyone. Section 6. The Raj Rajaratnam case inside the Galleon Group. Raj Rajaratnam, founder of Galleon Group, orchestrated one of the largest insider trading schemes in history. He used a vast network of contacts to obtain confidential information. Rajaratnam cultivated relationships in various industries. Insiders provided tips on earnings, mergers, and market-moving events. He made millions in illegal profits. The case relied on wiretap evidence, capturing Rajaratnam discussing illegal trades. In 2011, he was found guilty and sentenced to 11 years in prison. Section 7. The consequences of insider trading. The consequences of engaging in insider trading are severe and can have a devastating impact on one's personal and professional life. Firstly, individuals convicted of insider trading face substantial fines and lengthy prison sentences. The SEC and the Department of Justice take a hard line against insider trading, seeking to deter future violations. Secondly, insider trading convictions can result in professional ruin. Individuals found guilty of insider trading are often barred from working in the securities industry, effectively ending their careers. Thirdly, the reputational damage from an insider trading scandal can be irreparable. The public perception of insider trading is highly negative, and those involved are often viewed as unethical and untrustworthy. The consequences of insider trading extend beyond the individual. Companies associated with insider trading scandals often suffer reputational damage, loss of investor confidence, and decreased stock value. Section 8. The role of the Securities and Exchange Commission, or SEC. The Securities and Exchange Commission plays a crucial role in combating insider trading and maintaining the integrity of the US stock market. Established in 1934, the SEC is an independent federal agency tasked with protecting investors, maintaining fair and efficient markets, and facilitating capital formation. The SEC's Division of Enforcement is responsible for investigating and prosecuting insider trading cases. They employ a variety of methods, including market surveillance, tips from whistleblowers, and sophisticated data analysis to detect suspicious trading activity. When the SEC identifies potential insider trading, they conduct thorough investigations, gathering evidence through subpoenas, interviews, and document reviews. If the SEC believes there is sufficient evidence of wrongdoing, they can bring civil charges against the individuals or entities involved. The SEC also works closely with the Department of Justice on criminal insider trading cases. The DOJ has the authority to bring criminal charges, which can result in significant fines and prison sentences. Section 9. Tips for staying on the right side of the law. Navigating insider trading laws can be challenging. Here are some tips for staying compliant. Be aware of your company's insider trading policy. Follow your company's policy diligently. Avoid discussing confidential information in public places. Be mindful of your surroundings. Consult your legal department if you have questions. Section 10. The importance of ethical conduct in finance. The cases discussed in this essay highlight the importance of ethical conduct in the financial industry. Insider trading undermines the fairness and integrity of the market, erodes investor confidence, and can have severe consequences for those involved. Ethical conduct is not just about following the law, it's about doing the right thing, even when no one is watching. It's about putting the interests of clients and the integrity of the market ahead of personal gain. The culture of ethics starts at the top. Senior leaders in financial institutions have a responsibility to set the tone and create an environment where ethical conduct is valued and rewarded. Section 11. Conclusion: upholding market integrity. Insider trading is a serious offense that undermines the fairness and integrity of the financial markets. It creates an uneven playing field, erodes investor confidence, and can have severe consequences for those involved. The legal framework surrounding insider trading is complex and constantly evolving. However, the underlying principle is clear. Individuals with access to material, non-public information have a duty to safeguard that information and not use it for personal gain. By understanding the definition of insider trading the legal consequences and the ethical implications, individuals can help maintain a fair and transparent market for all participants.